what connects a shrinking factory floor in Shenzhen to a vault crisis beneath the streets of Manhattan? The answer is currently worth over $30 an ounce, and the institutions that control its pricing mechanism are running out of ways to keep it there. Somewhere in the last 72 hours, the silver market just sent a distress signal that most investors will never hear, not because it was subtle, because the infrastructure designed to muffle it worked exactly as intended. A single transaction, 159 million ounces of silver, hit the exchange and forced a trading halt. That number is worth pausing on. The total registered inventory at COMEX, the metal actually earmarked and available for physical delivery, sits below 60 million ounces. One order demanded nearly 3 times what the vault system could produce. And the exchange froze. Not a software error, not a fat finger trade. The mechanism that connects paper promises to physical metal encountered a reality it could not process, and it shut down rather than expose the gap. This is not a story about a number on a chart reaching a round figure. This is about the architecture beneath the number, the plumbing that connects paper contracts to actual metal, developing fractures that grow wider every delivery cycle. The target everyone is watching is $104. But the real story is not where silver is heading. It is why the system that prices silver is losing the ability to contain it. In the same week that order choked the exchange, silver outperformed gold by a ratio of 4 to 1 during a geopolitical shock. 8% against 2. That ratio is not noise. In a normal environment, gold leads the safety trade. When silver moves 4 times faster, it tells you that sophisticated money is not just buying protection. It is buying leverage against the very system that has suppressed this price for decades. The capital flowing into silver right now is not scared money hiding in a bunker. It is strategic money positioning for a structural repricing that the institutions managing the paper market cannot delay indefinitely. To see the full picture, we need to start where most Western analysts refuse to look. 6,000 miles east of the COMEX vault, in the boardrooms, where the next decade of commodity strategy is being decided right now. China's Purchasing Managers Index just printed 49.1. Below 50 means contraction, factories slowing, output shrinking. On the surface, this looks like weakening demand for industrial silver, the metal that runs through every solar panel, every electric vehicle battery contact, every high-performance semiconductor. The obvious read is bearish. Less production, less silver consumption. That obvious read is wrong, and understanding why it is wrong is the key to seeing what comes next. Here's what the surface number conceals. When Chinese manufacturing decelerates, Beijing does not sit idle. The Politburo just issued language pledging more proactive and effective economic policies. In the dialect of Chinese state planning, that phrase is a loaded weapon. It means stimulus is coming. Rate cuts, reserve requirement reductions, infrastructure spending at scale. Premier Li Chang is expected to announce a growth target of 4.5% this week, down from 5%. But the policy apparatus behind that number is gearing up to spend its way back to momentum. And infrastructure spending, at its molecular level, consumes silver. Every bridge, every power grid upgrade, every data center requires it. But there is a second layer most analysts are missing entirely. China has been fighting what economists there call involution, a deflationary spiral where manufacturers slash prices to survive, destroying margins industry-wide. The government is now signaling it will phase out industrial subsidies and impose price floors across key sectors. That means the race to the bottom ends. Margins recover, capital reinvests in technology and productivity. And every upgrade in manufacturing technology, every efficiency gain, every next-generation production line requires more conductive metals, more strategic materials, more silver. If this kind of structural analysis is sharpening how you see this market, take a second and hit subscribe. Because the mechanism I'm about to explain is the part that connects everything, and it is the part almost no one is willing to say out loud. While Western paper markets set the headline price, Shanghai premiums have stayed persistently elevated. Every time COMEX futures get hammered down, physical silver in Asia trades at a premium that refuses to follow. That spread is a message. Eastern buyers are valuing the actual metal higher than the Western paper price suggests, and every dip shakes metal loose from Western hands into Eastern vaults. Vaults controlled by entities that do not trade on margin, do not face margin calls, and are building strategic reserves measured in decades, not quarters. Once that metal flows east, it does not come back. Now bring that understanding back to what happened on the COMEX floor last week, and the picture changes completely. The silver market operates on a useful fiction. Thousands of paper contracts trade every day referencing silver that no one intends to physically collect. Futures, options, derivatives, all of them create the illusion of a deep and liquid market. Participants settle in cash. They are trading the price, not the metal. The system functions because the overwhelming majority never knock on the vault door and say, hand it over. But the fiction depends on one critical assumption, that the small percentage who do want delivery can always be satisfied. Remove that assumption, and the entire pricing mechanism sits on a fault line. That 159 million ounce order did not just exceed available supply, it exceeded it by a factor of 3. Picture a banking system that issues loans against deposits it holds. It works beautifully as long as withdrawals stay within a predictable band. But when the withdrawal demand spikes to 3 times the cash in the vault, the system does not bend. It seizes. That is precisely what happened. The exchange halted trading not because of a technical glitch. It halted because the math between paper obligations and physical reality momentarily became visible, and the visibility itself was the threat. This does not mean COMEX collapses tomorrow. It does not mean delivery failure is imminent next week. What it means is that the buffer between the paper market and physical reality is thinner than it has been since the 1970s. And the stress is not dissipating, it is compounding. Registered inventory continues to drain. Physical premiums remain elevated while the spot price gets managed lower. Lease rates, the cost of borrowing actual metal, are climbing in a pattern that tells you someone, somewhere, needs silver badly enough to pay up for it rather than wait. And that is before we arrive at the next inflection point. March 1st is notice day for COMEX silver futures. Contract holders must declare, are you rolling forward or are you standing for delivery? With registered inventory below 60 million ounces and Eastern demand pulling metal out of Western circulation, this notice day carries a weight it has not carried in years. If a larger than expected number of contracts stand for physical delivery, the exchange faces a decision tree with no comfortable branches. Find the metal, face a squeeze, or change the rules mid-game. And rule changes during a delivery crunch are the loudest alarm the system can sound. They tell you the architecture is being modified in real time to prevent an outcome it was never designed to handle. So here is where the threads converge into something the institutions would rather you did not assemble for yourself. Deutsche Bank just revised their silver outlook, warning that the gold to silver ratio sitting at 57 presents what they called significant upside risk to their $100 per ounce forecast. Translated from the careful language of institutional positioning, they are telling their clients that silver is historically cheap relative to gold, and the ratio is likely to compress violently. Eric Sprott, who has been accumulating physical metal longer than most retail investors have been aware silver existed, has warned publicly that the current trajectory points toward a revaluation shock, measured not in tens of dollars, but in hundreds. The technical structure confirms the institutional thesis. On the 4-hour time frame, silver has broken out of an ascending channel and reclaimed 91.33, a level that served as resistance for weeks and has now converted to support. That flip matters. Above that floor, the next barrier is 95, the final psychological gate before triple digits. Clear 95 with conviction, and the channel projection extends directly to $104 as the next structural objective. But here is the question that should sit with you longer than any price target. If the physical market is bleeding inventory, if Eastern buyers are absorbing every dip, if institutional forecasts are racing to catch up with a move already underway, then who exactly benefits from the paper price staying suppressed? And what happens to their position when the suppression mechanism finally fails? I read every comment on this channel, and some of the sharpest analysis comes from this community. Tell me where you think the breaking point is. Drop it below. Now, the path from here to 104 will not be a clean line. Silver never moves in clean lines. The RSI is pressing 70, which means momentum is powerful, but the market is entering territory where corrections become probable. And this is where the real trap gets set, the one designed to separate you from your position at exactly the wrong moment. Margin. When silver moves, leveraged positions look brilliant. Every dollar of price movement multiplies in your account. You feel like you have found the edge. Then the exchange raises margin requirements. Suddenly, your position needs more capital behind it. If you do not have it, you do not get to hold through the shakeout. You become the shakeout. Your forced liquidation pushes price lower, which triggers the next round of margin calls, which triggers the next round of forced selling. It cascades mechanically, a chain reaction that has nothing to do with supply or demand, and everything to do with who has staying power and who does not. The deep-pocketed institutions wait for exactly this flush. They let the leverage unwind, let the weak hands get cleared, and then they step in and buy everything the forced sellers had to surrender at a discount. That is not a market correction. That is a wealth transfer with a technical name. So the question is not whether silver reaches 104. The structural forces, the physical deficit, the Eastern accumulation, the institutional repositioning, the technical breakout, all of it points in one direction. The question is whether you will still be holding your position when it arrives. And the answer to that depends entirely on whether you know what you are and act accordingly. If you are a trader, the 91.33 level is your reference point. Daily closes above it mean the trend is intact. Look for entries on pullbacks to that zone with defined risk beneath it. Target 95 first, then 104 if 95 gives way. If you are an accumulator, stop trying to time the perfect entry. You are not trading volatility, you are acquiring a strategic asset during a period of structural repricing. Use the shakeouts to add weight. Do not use leverage. Do not buy more than you could hold through a 50% drawdown, because even in a legitimate bull market, silver will test your conviction in ways that feel personal before it rewards your patience in ways that feel inevitable. And if you're still trying to decide which approach is yours, decide now. The market will force clarity on you at the worst possible moment if you have not already found it yourself. There are 3 signals that cut through the noise for anyone willing to watch them. First, the relationship between spot price and futures. When futures trade above spot, that is normal. Storage costs, time value, standard, contango. When spot trades above futures, the market is paying a premium for metal right now over promises of metal later. That inversion is urgency made visible. Second, lease rates. When the cost of borrowing physical silver spikes during a paper price decline, someone needs actual metal badly enough to pay a premium for temporary access. That divergence tells you the dip is manufactured, not organic. Third, the Shanghai premium. Compare what COMEX says silver is worth to what buyers in Asia are actually paying. When that gap persists through sell-offs, you're watching 2 markets price the same metal at different realities. Eventually, one of those realities wins. Watch which way the convergence moves. That tells you where the truth is. At the open of this video, I asked what connects a factory floor in China to a vault crisis in Manhattan. Now you know. The connection is silver, and it is being pulled in 2 directions by 2 systems with incompatible needs. One system needs the price contained to preserve the credibility of paper markets. The other needs the physical metals secured to fuel the next industrial era. Both cannot win. The architecture that has held this tension in place for decades is developing cracks you can now measure in real time. The only variable left is whether you see the blueprint clearly enough to position on the right side of it before the arbitrage closes for good.